Lately, it seems the stock market can only go in one direction, higher. But for some of us, we're expecting a reversal. If this includes you, well, you're not alone. We recently launched a poll. Where do you think the next big stock market trend will go? 30% voted we're going to all time highs, maybe even beyond. But 49% voted in favor of a bull trap, which means that the big move up may soon turn into a big reversal back to the downside. We're going to discuss a very simple way to identify perhaps the best candidates betting on a reversal. Every square here represents a different sector within the S&P 500, including the actual index itself. We're using gauge charts. They're very simple to use. On the left-hand side, that represents the low price of each respective sector as of April 7th. What's April 7th? That's the low of the tariff crash. We're measuring the stock market performance from that low to present date. On the right-hand side, that represents the highest price each respective ETF achieved between April 7th and present date. And where the green bar ends, well, that's where we are right now. So the further the green bar extends to the right, the higher the stock is to the highest price we've seen since April 7th. Well, let's consider XLU. It's very close to a 1-month high. You see that green bar extends all the way to the right. Well, that's not the exception, but rather the rule. In fact, almost every single sector within the S&P 500 is at or very close to its 1 or 2-month high. We're going to look for the exceptions. When the general market is strong, look for those stocks or sectors that are falling behind. That can be quite revealing. So we'll start with XLV. What's that? That's healthcare. Its holdings include UNH, United Healthcare, J&J, Pfizer, Merck. In recent news, a criminal Medicare fraud investigation was launched into United Healthcare. There's rising medical costs and the resignation of the CEO from that particular company. Overall, the trend, there's a broad market rotation away from defensive sectors. XLV healthcare stocks are considered by most to be a defensive position. They don't go up as much as other stocks like technology, but they tend to defend their capital in times of stress. Let's consider also XLE. XLE is energy. Its holdings include ExxonMobil, Chevron, Schlumberger, many others. In recent news, volatile oil prices, weak oil prices, geopolitical tensions, concerns over slowing global demand, that has all weighed heavily on the energy sector. In terms of the trend, there's a rotation to growth and tech out of the commodities. Commodities, we're talking about energy and oil commodities, natural gas, not gold and silver. That's a different story. Also, what's been weak? XHB. What is that? Home builders, DHI, Lennar, many others. In recent news, the rising mortgage rates linked to that soaring 10-year bond yield and a softening housing demand and cautious consumer sentiment. That's all weighing heavily on the home builders. In terms of the overall trend, there's a market rotation away from interest rate sensitive sectors. There's probably not a sector more sensitive to interest rates than the home builders. So, what are the common themes between energy and home builders? We're excluding healthcare because that UNH story really was devastating to the stock, but it's a stock specific story and it doesn't necessarily speak to the overall strength or lack thereof in healthcare. But let's take a look at energy and home builders. What do they have in common? Well, they have interest rate sensitivity. Higher rates reduce demand. There's a cyclical sector exposure of both of these industries. They perform best during economic expansions. Well, you could say that about technology and many others. But what we're going to see in the moment is that these particular sectors are actually quite sensitive, more so than others. There's also commodity driven input costs to consider. It's impacted by price swings in oil, lumber, steel, etc. You may say, well, wait a second. If lumber prices are cheap or oil prices are cheap, shouldn't that be good for home builders? Can't they build more homes with cheaper raw materials? But there's two sides of the story. It's not only that, well, what will benefit from weak oil prices, but we should also ask, why are oil prices so weak? Maybe that's lack of demand. Lack of demand from the home builder index is bringing down these commodities, and that speaks to the overall economy. There's also a capital intensive business model, and this is probably the most important to consider. There's high upfront investments exposed to credit and financing conditions. You see, when we talk about, let's say the technology sector, NVIDIA, AI, they're not very capital intensive from the consumer point of view. If we want to implement AI into, our own lives or business, it doesn't require that much capital as opposed to an energy or manufacturing sector, home builders, that takes a long time and a lot of capital to be committed. So when we see these particular sectors like energy and home builders begin to falter, it says something about the economy. It says that the economy is strong enough to support Amazon and Nvidia, relatively speaking, lower capital intensive, businesses, but the economy is just not strong enough to support everything. And those energy and home builder sectors are usually the first to falter. Now, in terms of our poll, 49% voted for a big reversal lower. Well, it's a little scary to sell short continuous green candles. But when we're looking for candidates to sell short, we should look for those sectors or individual stocks that are showing signs of weakness first. What are the takeaways from all this? A rising tide lifts most boats, not everything. Only a very strong stock market or stock market bubble will we see every stock go up. That's not the case. We're in a stock picker's market here. A lot go up, some go down. Strong markets reveal weak trends. It shows us the outliers. And the underperforming sectors highlight imperfections in the economy. Every economy is different. The economy we have right now seems to be benefiting certain companies like Tesla's on recovery and Amazon and Nvidia we mentioned. But the type of economy we have right now is just not strong enough to support also energy and home builders. And that is quite revealing. That tells us something about our current state. We hope this has been helpful. We look forward to seeing you back soon.